Why does the idea of revaluing America's gold keep resurfacing, and why this year more than ever? What does it say about the state of the US dollar and the mindset of its stakeholders when the Federal Reserve itself, i.e. the world's most powerful monetary authority, finds itself calmly discussing how to turn millions of ounces of unspent gold into spendable cash? It seems to me that last week's post by the Fed, that one that examined how revaluation can and has worked, isn't actually about revaluation. It's about something else. Let's find out. The idea of revaluing the United States gold reserves is a notion that refuses to die, and not because it's brilliant, but because it's useful, not economically necessarily, but psychologically. It's the financial equivalent of emergency whiskey kept in a drawer marked break glass if debt spirals out of control. The concept has been ridiculed, dismissed, and periodically reanimated by everyone from libertarian think tanks to late-stage presidents, and more recently, the US Federal Reserve itself. Just last week, the Fed published a blog that calmly walked readers through how governments might unlock value from their gold reserves without issuing new debt or raising taxes. The Federal Reserve's paper, Official Reserve of Revaluations, The International Experience, reviews how 5 countries have used valuation gains from gold and foreign exchange reserves to offset losses or reduce debt. Now, it outlines how a similar revaluation of US gold reserves, currently valued at $42.22, could theoretically unlock hundreds of billions in accounting gains, though it stops short of endorsing or rejecting the idea. So in short, discussions of gold revaluation are no longer fringe theory. They are a key part of elite policy discourse. And the question then is not whether a gold revaluation is imminent. It is, why does the idea continue to surface? And the answer, of course, lies in what the debate reveals. The persistence of gold revaluation as a talking point doesn't indicate a clever accounting trick is about to be deployed. It signals that policymakers are running out of palatable options and that the architecture of public finance, once held together with discipline and surpluses, now leans heavily on smoke, on mirrors, and the faint hope that gold might still save America's day. It would appear the debate over gold revaluation, much like gold itself, refuses to be reburied. And perhaps that is because the underlying problems that it's gesturing towards, excessive debt, diminishing monetary credibility, and the search for painless fiscal remedies, are themselves persistent. In a world where political consensus is scarce and fiscal restraint is scarcer still, gold remains the one asset that has not been debauched or diluted or digitally conjured into being. And so serious people in serious suits are again discussing whether the US should revalue its gold reserves to plug holes in its public finances. To the casual observer, the idea might sound harmless enough. The United States holds over 260 million ounces of gold, officially priced at over $42 per ounce. Now, if you revalue that to the market price, which at time of recording hovers around 3,300, well, you generate a tidy $760 billion in unrealized gains. And this, we are told, could be transferred to the Treasury to pay down debt, to fund spending, or even endow a sovereign wealth fund. Now, unlike raising taxes or issuing bonds, revaluation seems painless, maybe even elegant. It is in theory a free lunch. And when was the last time any politician or central banker turned down one of those? Now, as we have explained before, this idea is not new. President Roosevelt revalued gold in 1934, lifting its price from $20.67 to $35 per ounce in order to value the dollar and inject capital into the New Deal. In 1973, Congress set the current statutory price of $42.22, just as the United States was unhooking itself from the gold exchange standard. Now, the figure has remained untouched since, preserved like a museum piece in the books of the US Treasury, while gold's market price has soared more than 70-fold. Now, what has changed is not the mechanism, but the desperation. The United States now carries a public debt burden that exceeds its GDP and faces structural deficits as far as the eye can see. And so the temptation to unlock a few $100 billion in dormant value is understandably strong. And when Donald Trump and Elon Musk, who are not two men who are known for restraint, previously called for an audit of Fort Knox and hinted at the idea of revaluation, well, their proposal, however vague, it struck a chord with those who believe that the existing financial architecture is failing and that gold, this oldest form of money, may once again have a role to play in its repair. Now, proponents argue that revaluation would legitimise gold's monetary status, reduce the need for further borrowing, and provide this non-inflationary source of funding. And of course, some envision a gold-backed sovereign wealth fund, and others fantasise about a digital currency tethered to revalued gold reserves. The most fervent of these proposals border on the theological, with gold cast as an instrument of redemption for a financial system that has wandered too far from fiscal virtue. But beneath the glitter lies a far less convincing reality, one that raises four key issues. The first and most obvious problem is that the whole exercise is an accounting illusion, because the gold itself does not move. It's not sold, leased, or otherwise monetized. The revaluation simply marks up one asset on the central bank's balance sheet and creates a corresponding liability to the Treasury. It is, in essence, just a spreadsheet operation. It's like rearranging the furniture in a burning building to slow down the fire. It might look productive, but it does not address the fire. And worse still, should the Treasury decide to spend the revaluation proceeds, and there is little reason to believe it would not, well, the result would be an increase in commercial bank reserves. And this is functionally indistinguishable from quantitative easing. Now, unless the Federal Reserve sells other assets to offset the liquidity injection, inflationary pressures are likely to rise. So one could sterilise the impact, but that would entail tightening monetary conditions at a time when financial markets are already twitchy. Now, the second issue is political. The statutory price of gold can only be changed by Congress, and in the current climate, convincing lawmakers to agree on the time of day is challenging enough. And any serious attempt to revalue gold would be seen quite reasonably as an admission of fiscal distress. It would likely unsettle the bond markets, raise questions about the dollar's stability, and risk further politicising the Federal Reserve's already delicate mandate. Now, the third concern is credibility. Central banks prize their independence, and rightly so. When Germany's government attempted to use gold revaluation proceeds to meet the Maastricht criteria in 1997, the Bundesbank resisted fiercely. Newspapers accused the government of cheating. Public trust wobbled. A partial compromise was reached, but not before the episode became a case study in the perils of using central bank assets to solve political problems. But the lesson was clear. Even when the arithmetic adds up, the optics may not. And finally, it is also worth remembering that once gold is revalued, the temptation to spend it can quickly lead to the temptation to sell it. And once sold, it can't easily be required. Gold is not only a hedge against inflation, but is a strategic asset. It represents trust and permanence and an anchor in times of geopolitical turmoil. To treat it as a fiscal piggy bank might soothe these markets temporarily, but it would really erode the very foundation of that trust. Now, international precedents offer very little reassurance. Italy used gold revaluation in 2002 to cover central bank losses. South Africa did something similar just last year, transferring a portion of gains to reduce borrowing. Curacao and St. Martin executed clever sale and buyback maneuvers to realise paper profits. Lebanon resorted to revaluation in 2002 and 2007 in a failed bid to escape a mounting debt crisis. Each case, it provided temporary relief. None solved the underlying problem. So why won't the idea die? Because it speaks to something deeper. The fact that the Federal Reserve is now writing blogs about gold revaluation with balance sheet diagrams and GDP comparisons, this is not a coincidence. I'm not saying this is a call to action, but you do have to see it as a subtle shift in posture. Now, the note itself is remarkable not for what it says, but for what it declines to say. Because it describes the mechanics, it summarises the history, and it lays out the potential impact. It does not endorse, but it also doesn't condemn. There's no recommendation, no forecast, and certainly no alarm. So what is it? Well, the first possibility is that this is a trial balloon disguised as research briefing. By presenting the topic in the language of neutral international comparison, the Fed may well be introducing the idea into elite policy discourse, not to try and provoke a decision, but to ensure that the idea is in circulation should the political appetite emerge. Should revaluation one day become necessary, this groundwork has already been laid. Now, the second possibility is more philosophical. The Fed's note concedes, however indirectly, that gold still matters. For decades, central bankers have insisted that we have moved beyond gold, that monetary policy was now a science rather than an art. But here is the world's most powerful central bank quietly explaining how one might go about converting gold's unrealized value into state capital, not oil or digital tokens or carbon credits, but gold. The most unfashionable of metals, the most ancient of assets, quietly reclaiming a seat at the table. Now, a third possibility is that the paper forms part of a broader emergency manual, a contingency plan, sort of inked in pencil for when conventional tools have been exhausted. The US fiscal trajectory, after all, is not a gentle incline. It more closely resembles the side of a volcano. Under such conditions, even the most unorthodox tools might find their way into circulation. The publication of this paper does not mean revaluation is imminent, but it does mean it is no longer unthinkable. And that is the point. When an idea moves from sort of fringe fantasy to policy adjacent feasibility, something has changed. Gold revaluation is no longer this subject of libertarian newsletters or precious metals YouTube channels. It has been diagrammed, it's got footnotes, and it's been released to that by the high monetary priests of Washington. That alone is a quiet milestone. It tells us that the system is not as stable as it claims, and that gold, that immutable asset, may still be called upon to do something it has not done in decades: save the system from itself. Now, right now, not for a moment do I believe that a revaluation is likely in the near term. But the fact that it has been mapped and modelled and distributed by the Federal Reserve suggests to me something more important, that the idea is no longer unmentionable. And when gold shifts from unmentionable to plausible, even only on paper, well, to me, that is a signal worth paying attention to. With all this chatter about gold and how it works for countries and their balance sheets, it's well worth asking how it can work for you. If you are just starting out on your gold journey or know someone who is, then why not download our free guide to gold, where we walk you through 5 key secrets that everyone must know when it comes to gold investing. The link is in the caption below. Enjoy.